Our European Equity Dividend Fund has three objectives. The first is to participate in the upside of the equity market. The second is income generation. The third is that through our portfolio construction, we want to offer less volatility than the general market. And the main approach we do that is to combine both quality and yield. Quality means that we can generate good cash flow, and yield is exactly what we look for this strategy. One key feature for our product is that each stock that we bring into the portfolio is a dividend stock, which meets our minimum dividend yield requirement. And hence, we create a dividend portfolio that is really truthful to label. And the way we do that is that we look for companies with very sustainable business model and very strong free cash flow generation, because we believe strong cash flow generation is the best guarantor for dividend payments over the long term. And it's also very important for us to use the dividend yield to guide our buy and sell discipline. What usually happens is that if the dividend yields gets too high, it could be a sign that a good business, people are getting too negative about it, and it's a moment opportunity for us to buy this stock. On the contrary, if other investors are too excited about certain stock and the valuation goes up and the yield gets depressed, and usually that's a moment for us to consider trimming that position. Well, the European earnings so far have been very good, and the majority of the companies what we have seen so far have been beating market expectations, and hence what we see for Europe for 2025 based on the current consensus forecast is around a 3 to 4% earnings growth. In terms of the prospects, I think it depends very much on the outcome of the trade negotiations with the US. Having said that, I need to mention that the European corporates have sounded some caution for the next couple of months, which is understandable because the outcome of the trade negotiations with the US is very, very hard to predict. We do believe that European markets have a good chance to continue with the outperformance because the valuation of Europe is still very attractive and the earnings growth have been more or less resilient. That would provide a very good basis for further good performance going forward. Markets can go up, markets can go down, but the dividend stream is always the most stable source. And as the saying goes, a bird in the hand is better than two in the bush. I think during times of uncertainty, very stable income, very stable dividend stream is exactly what investors look for. I would like to mention two sectors in our portfolio. The first one is the financials. We think the financials still offer a lot of upside and very interesting opportunities. For example, the banks. The banks, with the normalization of interest rates in Europe, and their profitability has come to the normal level, and that is still very much underappreciated by the market. They have very, very attractive capital deployment policy as well, and with very good dividend and buyback strategies. The second is the insurance in the financial sector, and the insurance is always a very stable source of capital generation, which is in turn also returned to investors as dividends. The second sector I would like to emphasize is in the industrials. In Europe, we have a lot of industrials champions. These are the companies which benefit also from the infrastructure build out in Europe, and also they have very attractive dividend policies.